Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co-host here alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, home insurance, surging inventory levels, AI, rent vesting, and much more. But first, Stephen, what is happening in the ginormous Thomas household?
Well, we went to Palm Desert over the last weekend and it was fun. People are going, "Why are you going there?" The high was like 115, but on Sunday it started out like a 109 and then a big storm came and we had this massive rain clouds and it rained like crazy for an hour. It rained 5 inches in that hour and it hailed and kids were having fun. We were able to go in the pool with because it was warm out and it's just a fun memory. So that's what we did last weekend. And then this coming up week, we're actually going camping. We do this annual camping trip with uh, my wife's family, and it's at the beach in these vintage trailers. And we do it every year. So we'll be doing that for a few days next week. And we'll just call it a wrap because the kids are so busy in camps and things like that. It's obnoxious how many camps and how many Uber rides they need all over the place. And my wife and I are the Ubers. So that's what's going on for us, just enjoying summer. How about you? What's going on in your neck of the woods?
Well, woke up a couple days ago feeling a little bit off and just thought it was a typical cold, but apparently there's something going around again and it's called COVID. So I have COVID right now, which put a halt on some of my plans for this weekend, which is a bummer. However, I'm still able to see Arsenal next weekend, so there's still some positives, of course, to look forward to. I'm not too sick, really. I just sound a little bit nasally, so if I sound a little bit off, I do sincerely apologize. But so far, so good. A couple days in and almost done already. Like, I've been okay, thankfully, and just looking to feel better and go back to my normal routine with work and everything. And we'll see. Everything should be good. But, Steven, what's been happening in the real estate world with supply, demand, and our very own expected market time?
It's like the normal summertime slog, and everybody expects summer to be this incredible time for housing. Yet like I just described, lots of distractions with families and things. And people, even if you don't have a family, you've got vacations, you want to enjoy the beach, you want to do different things. It's enough where you could see demand come down a little bit, number of pending sales decreases. And then we are continuing to have inventories climb from week to week. And so inventories have not yet really found a peak. They typically peak in the summer months between as early as July in many markets to as late as September. And very, very few markets are later on in the year. Those are for the snowbirds, and we have arguments as to why they shouldn't even come on the market at that time. They should come on in the spring because demand peaks in the spring and slowly makes its way down. So if demand is coming down and we have the inventory rising, expected market times are still climbing higher until we find that peak and it starts to come down at similar rates to demand. So until then, it continues to climb. So if you're in the market and you were in the market a month ago and you're a buyer thinking, yeah, it's starting to slow a little bit, I could take my time, it is even slower now. So, and if you're a seller entering the market, absolutely you need to take into consideration what is going on in the marketplace right now today, what I just described. And there are certain markets that over the last couple of weeks we looked at it, and there was like a jump in 10 days longer for market times. That is a real shift in the marketplace where people can really feel a difference. That it seems a little slower, Stephen. What's going on? It's called summer. And that's exactly what typically happens at this time of the year. It downshifts from spring.
So we've also had some action in the economy over the past couple of weeks. I wanted to ask you what has happened.
Well, the last time we had one of these, we talked about labor. That was the first week in July. That was, even if it was 4th of July week, it was also jobs week. So that was an important week for rates because it really does point to a softening in the jobs market, which is good. It's not like it's shutting down and people are losing their jobs all over the place. We have a rising unemployment rate, and there's a better churn, there's a better mix. We want more unemployment to match the number of jobs that are opened and available, so that there's a good mix. When you have too few people looking and too many job openings, that's not a good mix. That puts pressure on wages to go up higher, and then that's inflationary. That's not what you want. You want a better churn, and that's what we're kind of getting, that better churn right now. And the longer the Fed waits, the more that we could actually see that it could slow further from here, and that's what they're starting to get nervous about. So that was that first week. Not this week that we just had. This week we had retail sales. Retail sales were kind of like it's mixed. It was like flat from month to month, and then they have this core group that they look at, but the core group thing was higher than it's been in a while. So it was kind of like a mixed bag. It really didn't do much to rates or investors. But the week before we had CPI. And CPI came down a lot more than anticipated. So all those people that thought that inflation was starting to rekindle and it was going to grow again earlier in the year, they were just wrong. It was just one blip. That was the month of March, the CPI print. And if you look at PCE, which comes out at the end of the month, which actually for us when we're recording this, and it comes out on Wednesday, it's just a couple more days later on Friday. So this coming up Friday, we're going to hear about PCE. PCE is actually the better of the two gauges, and that one's coming down nicely. It should say like 2.4%, and their goal is 2% for core. 2.4% sounding a lot like 2%, so it's definitely making its way towards where it needs to be, and it's the preferred gauge. So all the inflation's coming down nicely. We have jobs that's cooling quite a bit, and there's other headwinds. So it's indicating that, boy, we're going to get that rate cut sooner rather than later.
So when mortgage rates dropped, in our case, to the upper sixes, how long can we expect for that to reflect in the housing market?
Yeah, so we're finally down underneath of 7% for the first time in a long time. As a matter of fact, it's at its lowest level since February 1st. Yay. I think it bumped up. We're actually recording this thing on a Saturday because I did too much that we were doing on a Friday. So in looking at Friday, we actually had a bump in interest rates for no reason at all, pretty much. When you're looking at everything that's coming out, there really was not a really good reason for them to bump up. Sometimes when there's no noise, you get movement in rates, and it just has to do with the reshuffling, recalibration of people's portfolios, and it's obnoxious, and that's how rates work. But we're now below 7%, and it looks like we are here to stay. The further we go on out, unless there's some giant surprise that's lurking around the corner that we're unaware of, it looks like that this is where the slowdown is definitely hitting. We said there was about a 5% chance it would happen in the fall, and between spring and summer is about 50-50. So slight chance that it would slow down in the fall, but it looks like it didn't happen in the spring. It's happening in the summer, and we're getting that slowdown, which is pushing rates down. And as things slow more, we're going to see rates come down even further because they kind of illustrate where they feel that the Fed is going to go. And with rates coming down, yes, we're finally getting some relief. Buyers are contacting, or potential buyers are contacting lenders. They're contacting their agents. There's a little bit more movement in the marketplace. It just doesn't show up in the numbers yet because it's too soon. And that's why we always say that what we need to see is rates at a certain level with duration. Duration is a longer period of time than a minute. And so the longer that we remain below 7%, the better off the market will be with more demand, and then inventory will stop its rise and actually find its peak because we have these better rates. And as rates fall even further lower, you're just going to see even more of a rise in demand. And so that's kind of where things are at currently right now.
So if things keep heading in the correct direction with economic indices, and if the Fed cuts rates in September, what could that mean for the housing market and the economy?
Yeah, it's it's such a slight. The first one is so slight; it's only 0.25%. So it's not anything big. It's not like all of a sudden they do this and whoa, we're off to the races. But what this does is it actually it tells the world, and not just the United States. It tells the world that the Fed is now easing back off of their being as tight as they are by raising rates. Now they've said that they've achieved the job. Now we're going the other direction. That is a giant message initially. Subsequent messages, not as big. But this first one is a big one. And so when we do get it, markets will react. There'll be a big reaction. When we get further ones down the road, not as big of a reaction. So this one could be more of a sweeping kind of change. We could see rates come down quite a bit. It all depends upon also the language that is wrapped around it as well. So we'll just have to wait and see. But we're already pricing in rate cuts because that's why we've gone from we were at 7.5 in April as far as interest rates are concerned, and interest rates have come down since then, and now we're back into the sixes. So you can see that there's already a pricing in of these interest rate cuts, that it's coming. And the more that they see that there should be more out there, and the softer the economy looks, the more that we could see interest rates come down even further, which is why a lot of times when we have these interest rate increases or decreases, mortgage rates for the day can do the exact opposite of whatever the Fed did, because the Fed only controls short-term rates. These long-term rates go to where the Fed needs to be or where they think it's going to be, and it's volatile on a day-to-day basis. So it's not going to match up with exactly what the Fed does on that particular day in September.
So, as we've seen rates floating among elevated levels over the past couple of years, we've noticed a building inventory. So, according to Lance Lambert, 32 of the nation's 200 largest housing markets are back to pre-pandemic inventory levels. How long can this trend truly last?
Yeah, you have to understand there's a story behind this. You've got to be careful, and this is where people take this to the wrong level. They jump to a giant conclusion that, haha, so it's back. 32 out of 200 is the same thing as saying, what is that? My 16 out of 100, right? Sorry, a little slow in the morning here. 16 out of 100, which is 16%. 16% sounds a lot smaller than 32 out of 200. For some reason, they just put those numbers out there like that so that people can jump to their own conclusions. And guess what? YouTube and those doomsday doomers and gloomers, they jump all over this kind of thing and say, "Ha, see, I told you it's happening. This is the start. It's beginning right now." And there's a story behind it. You have to. It's Florida, which was overheated and continued to be overheated for way longer than everybody else, and Texas. Those are the two areas that were overheated, and they are home to a lot of those metros that they're talking about. And then there's a scattering of other ones, but there's always reasons behind it when you look at it. I mean, some of them you hear about, like San Francisco, let's say. San Francisco is a tiny little county. It's not the entire Bay Area, and yet the whole Bay Area will get lumped into that, and that's just not what the story is, but that's what the storyline it is, that the narrative that's played out. So there's these small micro markets that have their own individual problems, that have had problems since COVID, a lot of different movement and things. So it's a small percentage of the overall pie that we're taking a look at. And yes, inventories are rising, which is absolutely good news. We welcome it. And matter of fact, the more that we get towards that where it needs to be, pre-pandemic levels, is actually good news. Because if you're a buyer out there, you've been sitting back waiting for more homes to come on the market. And to see more homes that are accumulating on the market, and it's accumulating over and over and over on a month-to-month basis because more homes are coming on, and demand is very similar to last year. So if you have more homes coming on and demand's the same as last year, you're just accumulating extra product. And that's what's happening. And it's happening at a larger extent in those other areas. Here, it's good news because we can actually see that inventory levels, as soon as rates come down enough and it fuels a lot of demand, we'll have the supply to absorb those lower rates. That's the good news side of this thing. So we'll be doing more pending sales, more closed sales, and but the inventory won't be at catastrophically low levels. But if you still look at it in time, we're still at catastrophically low inventory levels for the country as a whole. There are more than there were last year. That's good news. But it's right to where we were in 2022 in many, many markets. And and it looks like it's going to, in markets, go past to 2020 levels. But at the end of the year of 2020. And 2020 was one of those years where we just kept on depleting inventory because rates went down to historical lows. So we're not to pre-pandemic levels for the country, and even pre-pandemic levels prior to COVID in January of 2020. It was the lowest January on record for inventory, going back to when NAR started producing these wonderful data points all the way to 1982. So we're an all-time low for a January, and it was low compared to Great Recession levels where we had mass amounts of price reduction. We had values plunging, and that's because we had about 4 times as many homes on the market back then. We're not climbing to anything near that. That's not what the story is. So sorry for those people expecting a crash. That's not going to happen because you actually need inventory for that to happen. It's not materializing.
So you recently did a video on this sort of topic, but 2024 was supposed to be a turnaround from 2023, but ended up being just as slow, if not slower, with demand being the same and inventory climbing even higher, as we just talked about. Stephen, how would you describe this year so far?
Yeah, so it's kind of what we said what was going to happen. We're going to have a very, very similar year, but we will do more units as soon as rates drop enough to fuel that demand with duration. We were hoping that it would come during the spring because that's where it lines up perfectly with housing. It didn't. It's coming during summer, and that's not where it lines up perfectly with housing. So it's off a little bit. So we will do more units, but from here on, you're looking at more units and you have more inventory. So what that means is that you're not going to get a lot of push on prices going down unless there are some areas, some markets where there's a certain product where there's just not enough and it gets depleted really quick, and then all of a sudden you have a scarcity issue. That's what drives prices higher faster, is when there's scarcity. We've talked about the extra supply. That's good news. And so we can do more units without there being immense pressure on values to continue to rise, because that's not actually what we're rooting for. We don't want to see a re-escalation, but that looks like ultimately, as rates float down lower and lower, where we're getting. So this extra supply will help minimize the how quickly it rises and escalates higher, which is the good news behind this. But that's what we kind of see. We actually see that, yeah, very, very similar. It's actually in some markets a little bit more. And you should see these big giant markets, there'll be like 100 more closed sales for the first 6 months of the year. 100 when there's thousands of closed sales. So it's so on par with last year. And on average, it's like on par with last year. So that's same demand. Yet more homeowners coming on the market this year compared to last year, which is good news because last year was nobody coming on the market. And they're just accumulating like what we talked about. So that's the story. That's the storyline of where we are at right now, which is actually kind of good news for now, because demand will increase and we'll have more supply to feed that demand.
So a spiraling insurance crisis has hammered Louisianans with high premiums, less coverage, and fewer options, keeping intense financial pressure on residents who are already facing rising costs elsewhere. With news like this floating around, more people are predicting a housing crash based off of homeowners failing to afford the higher premiums some insurance brokers are offering. So what are your thoughts on this topic?
Welcome to the party. We're in California. And they have the similar problems in other states. Welcome to Florida. Florida's way ahead of California as far as their insurance crisis is concerned. And they have there are many, many areas where it's popping up as a problem because, at the end of the day, insurance is for profit. And so with all these, when you hear these headlines of these tornadoes and hurricanes and floods and fires and you know, all the negative headlines that you see, and they're awful and they're natural disasters, and throw in their earthquakes and everything else. That all has to be backed up with insurance policies, and it's not inexpensive to replace a house. And they actually had to do a recalibration because the cost of rebuilding a house has actually gone up. So it's changed how much that they have to put out when they're insuring these properties. So they have to charge more to cover so that they don't have those losses. So that's what the whole entire game's about. So if you hear lots of headlines about all the natural disasters, insurance has to back that up, but they have to charge appropriately or they're out. That's what happened in Florida. That's what happened in California. They say, yep, you can't raise it enough. Well, then peace out. We're not doing insurance here. That's kind of the way that it's worked with the Department of Insurance here in California and in other places. So yes, as far as it causing a housing crash, man, I just hear it makes it so that yes, people do have to sell. We have had very, very few people that have had to sell. You know, like the divorce, the death, disease. There's all these D's that I can't remember them all. But there's reasons that people have to sell. But another one is default, and there's not a lot of defaults that are out there. As a matter of fact, we're sitting on more tappable equity than ever before. There is so much equity out there in the system with values the way that they've gone that there's not a lot of people that if they can't afford their house because of insurance, they can sell their house and do something else. The problem is they realize when they sell their house, they go rent something. Guess what? They got to look at something a lot smaller because how much their property rents for. A lot of these people can't afford the rent for their own home. So what they end up doing is they end up moving to something a lot smaller or moving completely out of an area. So that's kind of the direction that we're seeing is that we're going to get people that will ultimately have to sell. We don't have a lot of people in the marketplace that have to sell. That's good news. That's the proper churn. The churn has been missing, so we haven't had a lot of homeowners come to market. So we're getting that now. And if we get more and more of those people, it's just going to create more inventory. And these people have the equity to sell their homes. They're not distressed. This is not the Great Recession where people had zero down payments and subprime loans and couldn't really qualify for their monthly mortgage. You know what? With the insurance coming up just a little bit, guess what? Their payment's been fixed all this time, and they probably have to do calibration of their expenses because if they've been dealing with the same fixed payment for years, the change could be in some markets like in Texas, you have property tax changes that can push people out, but their overall fixed rate is staying the same. So these changes in insurance and taxes that go up a little bit higher, they're also making more on an annual basis. You can actually see in the different metros across the United States that the increases in the last 5 years have been stepped up in the household income. So yes, they're being charged more, but their fixed payment has remained fixed. And yes, they have these other parts of housing costs that are a little bit more, but they're also making more. So it's not going to create this avalanche. It's a news story. It's a narrative. It's going to be pushed because people need to sell papers and need people to click here and click there. And if you're a doom star, if you're on the YouTube and you're all about doom all the time and everybody clicks on me and I make $200,000 a year talking about doom all the time, you love this stuff because it's more content, but it's just doesn't materialize to what they're talking about. It's not going to cause a housing crash, that's for sure.
So, with homeowners insurance becoming such a large factor in places like California and Florida, and with price volatility in places like Texas, could we see more people head north?
Yes, there can be. There can be some people because the storyline is, that these areas are just getting too cost prohibitive, and There is a price to be paid to live in areas like California or along the coast in Texas. Or in Florida where they have two coasts. There's a premium for that, and it's where a lot of snowbirds like to leave all the coldness and come and live in some place where it's warm. Yeah, there are some people that are going to make the determination. Yeah, this is great. It's a little bit more costly. I'm going to go live on this lake instead over here because there's 5 million lakes in the middle of the country. I have learned because I like to go to lakes in the middle of the country for Airbnbs. So I can definitely see an argument for it, and we could probably see it happen over time. But it's not going to be this avalanche of people leaving, and there's no more Texans, and there's no more Californians, and there's no more Floridians. That's not going to happen.
On a more positive outlook, Florida laws tied to HOAs, condo hotels, insurance go into effect July 1st. My Safe Florida Home Program, the widely popular program acclaimed as a way to lower home insurance premiums, is relaunching with $200 million in funding that will go to $10,000 grants to homeowners to make storm-related improvements on their homes. So does California and Texas need to do something similar to prevent an unaffordability crisis in home insurance?
Yeah, they all have their own problems, their own fixes. This is kind of a fix, like a band-aid. 200 million sounds like a lot, but when you have these catastrophic trillion-dollar hurricanes that run through, now you see it's not a whole heck of a lot in the problem, the grand scheme of things. So, I mean, these are steps in the right direction. You also want to mitigate damage by offering incentives to go out and do these kind of things that need to be done. So it will help. And it will help in Texas because they have also the different hurricanes, so they could probably follow suit. We don't have hurricanes here in California. We have wildfires, so they have to do different things that they, getting rid of diseased forests as well as taking care of forest floors. And there's other things to mitigate the damage of wildfires. I'm not an expert in anything along those things, but I know that that's what they could do in the various areas, and there's money that's being thrown at it and all that. But it doesn't change the fact that slowly but surely we've gotten a little bit hotter, and the environment, we're seeing a lot more catastrophic tornadoes and different things like that. So the events are getting a little bit gloomier out there. So that's what we're trying to prep for, and so that's up to the smarter people. That's their lanes to figure out exactly what the fix is. But will it stop it completely? I don't think so. It's just going to create a problem for areas like Florida, California, Texas, and you now said Louisiana, and there's other states that are all subject to these same problems where it's a trade-off. You want to live in these certain areas. It's going to come with a premium, and people know what that premium is. So what it does is it filters out, and it's difference between the haves and the have-nots. People that can't afford to do it, they're not here. They're going to leave. They're not going to go to those states, or if they are and they get priced out, they're just going to move someplace else, like we just talked about in the question before. So that's more of what we're going to see is kind of movement, the different pressures, but it's not going to vacate. Not everybody's going to be leaving California. That's for darn sure. Or these other states. I just don't see it. People want to pay the premium to be in such a nice place.
So Los Angeles and Orange County housing prices 10 times more than earnings, according to a Harvard study. On that note, we mentioned one of the main ways to going about combating this affordability issue is by a now coined term called rentvesting, where someone rents their primary residence while trying to enter the housing market by buying a home that they can afford elsewhere. Is this something you'd recommend to every first-time homebuyer, or at least until rates drop?
I think this is fantastic. You can call it rent vesting. How about rent siblings or rent friends? Those are other things that you could do. Rent vesting is, I'm just going to get this little tiny 1-bedroom thing and continue to rent over here, but rent out that. Because it is such a premium. That's smart. I think that's great. That's one way. That's one pathway to home ownership. But it's not the house that you're living in. I like rent sibling, rent friend, rent roommate. It's where you can have you can rent out to a room or multiple rooms so that you can afford the overall mortgage payment by collecting rent to offset these mortgages, these hefty mortgages. And in your case, like right now, you're renting and you have two brothers and a cousin. Shoot, that sounds like a definite win for somebody, whoever's first on the rent sibling, rent cousin vesting. But you understand what I mean. It's a way in. I think it's great. You got to look at different ways in, because what we see is a reacceleration in prices down the road when rates start to ease. So that's what I'm more nervous about than anything else, because right now, if I look at the marketplace, and in certain metro markets, we'll just pick on LA. LA is one of those where it's high enough where you know that values are no longer going up. And they're not really going down, they're kind of flat. They can go down a little bit for the rest of the year, but this is a good time to get in. Because down the road, as soon as interest rates come down enough, it's gonna rekindle the demand, so that now supply won't be able to keep up with that amount of demand, and now we'll see a rekindling of values going higher. So the earlier you get in, the better.
So something that has baffled me over the past couple of years is the development of AI. So research by Delta Media Group found that 75% of surveyed US real estate brokerages have adopted AI. So the survey, also released in January, found that 82% of surveyed agents used AI to craft property descriptions. Two-thirds of those agents used it to generate blog posts, emails, and letters. 60% to create social media content, and 44% to create website content. With striving for success, is AI something you'd recommend for agents to turn to?
It's just another tool. I've been doing this for so long. That's why my hair is white and thinning. Um, and I have to wear a lot of sunscreen and hats and things like that. I'm starting to look my age. So the bottom line is, I've seen this before. It's always the shiny object. Now, this is a shinier object, granted. This people have compared this to the dawn of the age of the internet. I'm sorry, I can't. I can't, because the internet was a big thing. AI is big, don't get me wrong, but it's just another tool. Is it going to all of a sudden help you sell a whole bunch of houses immediately? Oh, heck no. As a matter of fact, I'll bet you couldn't even quantify what that is right now. That there is some time savings to it, but as we have learned when looking at it, that it's not perfect at all by any stretch of the imagination. I like to do lots of different photos for my presentations. I use different platforms for it. They have AI in it, and it's just not there yet. It just doesn't get me exactly what I want. So I have to turn to photos that are generated by people that have really cornered the market and really thinking outside of, okay, this is kind of new. This is kind of a great way of talking about this. And that's who I'm looking for. I'm looking for that creativity. I don't know how creative AI can be, rather than just bringing everything in together and then bringing it out and putting it in a nice sentence and a nice sentence structure and making it sound really pretty. So if you need that help, well, then yeah, that's a great tool, but it's not going to sell you more homes. It's not going to get you out there doing everything that you need to be doing with consistency on a daily basis in order to make a lot of money. That's the way sales work. Sales is getting out there, doing it over and over and over and over, repetitive. This will help with that repetition, but people will see through the repetition. What's more important is this dialogue, face-to-face, phone calls, meetings together, different things like that can't be replaced by AI. That's just hard work, and hard work will always pay off. So if you're looking for some like little silver lining, and AI is the big giant ticket item, this is not the first big ticket item. I've heard QR codes when they came out in the, gosh, can't I remember, like around 2000, it was like crazy, the early 2000s. Everybody was talking about QR codes. It was supposed to change and revolutionize everything. Yeah, we adopted a lot more as soon as we got to COVID, because we couldn't touch anything. And now we have a need for it. But is it that big life-changing thing? It was on real estate signs. It was on flyers. It was all over the place. Did we really utilize it to the extent that people thought? No. So I think we dramatize and we kind of romanticize where we think things are going to go, and I don't think it's going to be as revolutionary as everybody thinks it's going to be. It's not going to replace. It's going to replace some jobs, but it's going to create others. So, and that's kind of what the internet did. These people said it's going to, it's going to replace so many jobs. Internet was supposed to replace real estate agents. That's really, and brokers and things like that. And there were a lot of people who thought it was going to, but it didn't. So, that's my thoughts on AI. And yeah, I think it's great. It's a tool, but we're not going to lean on it so hard where we're going to make a lot more sales because of it. We're just going to get out there and do that by kicking behind.
Well, thank you everyone again for tuning into another episode of Let's Talk Housing and bearing with me with COVID. So now if you want to learn more about what is happening in the real estate industry across Southern California, the Bay Area, Phoenix, and Las Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. We greatly appreciate it. And if you have any questions at all, feel free to post it on any of our social media platforms, or you can email me at info@reportsonhousing.com. We will see you soon and have a fantastic rest of your day. Thank you.